Hello and welcome to this week's Middle Class Investor. This is Seth Martin, your host. We're just looking at the Middle Class Investor site here. A few of you are watching videos, but not very many. So be sure to tell your friends. We're getting very, very close to some difficult times in the market, and nobody wants to see their friends and family suffer. So tell them about the website. Tell them about the dangers that the market is stepping into. And if you don't feel comfortable advocating that, then go to them and show them Jim Rogers. This guy right here. He's one of the smartest guys in the history of the markets. So the reason I decided to do this, there's actually two reasons. One, it's a good engagement tool for me. It's a good way for me to stay engaged and look at the markets each week, so that I can make decisions for myself. But secondly, family, friends, some people encourage me to keep this up so that they can look at it from time to time. I think the thing is people aren't looking at it consistently, and that's probably okay. There's nothing wrong with most people don't want to look at the market every day. Most people don't even want to look at it weekly. But just make sure people know about it, because I'm going to show you some charts today that would indicate that this market's getting very, very tired. That doesn't mean there's still not a little upside. It just means it's very, very tired. So speaking of upside, we had a really solid week in the market. It's a very strong candle, and probably the last part of this little move here that I'm showing from here to here. We might have another week left, but I would expect. Earlier, a couple months ago, we were talking about maybe a triangle forming. I think that's dead. This is no longer a triangle, obviously, because this is much higher than this line right here. So it looks like to me that probably what this was is a continued this whole thing right here, from here to here, is basically all one move. You can kind of see here 1, 2, 3. This is 3 all the way up to here. Now we need a 4, or maybe this is all part of, let's say 3. This is where it gets difficult to tell. Maybe this is all 3, and then we still have a 4 and a 5, let's say, to there. And obviously this was 1, and this ABC was kind of a what's called a flat. As you can see, A, B, C. So that's 2, 3, and then we're looking for a 4 and a 5. And then that should be the end. That should be 5, a 5, a 5, a 5, a 5. Very large degree trend ending. And trust me when I tell you, you do not want to be in this market when this trend finally ends. Now, having said that, we've got a pullback, pretty good pullback, to maybe 2300, 2325, something like that. And then we got a big, pretty good rally up to maybe 2650. So there's still some upside. Let's call it 200 more points in this market. But 200 more points is not that much when you consider that once this trend ends, we're going to the 1750 area pretty quick. So when I say pretty quick, I mean within a few months. So really, it's important to understand where you are in the trend and start doing some what if kind of scenarios in your mind. What if the market pulls to here? What am I going to do? What if it does this? What am I going to do? So on and so forth. All right, let's look at the VIX. We know the VIX is low. It's been all over the news. That's all they talk about, is how low the VIX is. And it is low, and it seems like it's getting lower all the time. So if you're experienced in option strategies, you can buy some insurance here if you don't want to pull your money out. Most people are not experiencing those strategies, so I'm not going to spend a lot of time on it. But basically what you would buy is you would buy a put, and just think of it like insurance, like on your house. You know, you don't expect your house to burn down, but if it does, you have house insurance so that the insurance company can put your house back the way it was. That's why it's called a put. But you can see here the VIX is at the very bottom of this range that we've drawn here. And like I said last week or the week before, it's tightening up, and eventually it's going to pop out of here and probably pull back one more time, and then we're going to see significant volatility in the index. The Treasury, the yields, the short-term yields continue to go up, although they look like they're getting a little bit soft right here. As you know, the 10-year yield is the more important yield anyway, but the short-term yields are at a little over 1%, as you can see right here. And this on the right-hand side. Let's look at the 10-year. I think the 10-year is more critical. It's definitely more critical, and it's definitely the one you should watch. We talked about the 10-year pulling back into this box around this gap area. Of course, it has done that. Is it through pulling back? I don't know. I mean, we could have a little rally up here and then some more pullback. So it just depends. I mean, it could rally up here some and then pull back to here and then rally. So, you know, the market doesn't go straight up. These are very, very long-term trends that are taking long time to play out. I mean, just look at this pullback here. I mean, this thing is just a monster. So, you know, it's conceivable, even though this is a smaller degree trend, this pullback could be half as long as this whole pullback here. So this whole pullback lasted, you know, a little over 2 years, and this pullback's only lasted, you know, 6 or 8 months. So obviously this could go up, it could come back down and chop around for some time before it really starts taking off in its next move up. So you know, it's like I've always said though, you know, the reward, I definitely don't think this is going to make another low. So the reward in the yield, let's look at that real quick. The reward in the yield for your fixed income investments, your bonds and so on and so forth, is really from here down to here. And don't get me wrong, if you were in bonds and it goes all the way back down to here, you're going to make a lot of money. But I think the risk is to the upside, not the downside. So, but everybody has to make their own decision there. And I just encourage you to keep a close eye on it, and keep a close eye on what you have in your portfolio. Make sure you don't get caught with this taking off and you're not knowing what to look for. All right, so let's talk about some of these foreign countries. Germany, it's probably the strongest, Germany or Japan. And to me, their markets look very similar to ours. Again, Germany's likely to move up into this blue box. Before we get any kind of sell-off, got a little tickle in my throat. Let me take a little drink. Japan, you know, is stronger. You can see here that Japan's already in its blue box resistance area. United Kingdom is clearly weaker, and this is very corrective in nature. So you might see it pull up, make a new high here, and pull back up to the trend line, but this doesn't look like a long-term place to invest. Now, to me, the currency does, but the equity market doesn't. So, excuse me, I don't know how you can square that, but usually those would kind of go together, but they don't always go together. Nothing always happens in the market. So, but clearly the equity markets are weaker. So if you're looking at the FTSE, or if you're your investments are tied to the FTSE, just be aware of that. Likewise, if your investments are tied to the DAX, be aware that to me it looks like the DAX and the U.S. markets are going to probably move up and down together, but the United Kingdom, the British markets look like they're doing something different. So, all right, let's switch over and look at let's look at the euro first. Euro's been interesting and frustrating. We got this downward trend line here, and it's not respecting it, not as of yet anyway. Well, I say that it kind of broke through the trend line and pulled back. This line's been on here for a while. I drew it connecting these tops, and you can see here that the trend line has run up and has pulled back a little bit from that. That doesn't mean anything. I mean, it could pull back, a little bit like this, and then rocket up through here into this resistance box. And this resistance box, it's hard to tell, minimum it should be off of this swing here because this was the last swing into the high. But if this is all part of some larger pullback, this could be the swing that the box is measuring off of, which means it could be a little higher. So I don't know, the commercials and the way the market balance is for the euro right now is out of balance to the side of the bulls, which means you should expect some sort of pullback here, even if it's just to the midpoint of the trend line. All right, let's look at oil. We haven't spent a lot of time on oil lately. A lot of discussion about oil. When is it? Are the oil markets turning around? Are they, what are they doing? Well, certainly, near term we've got a little bounce here to probably this kind of area right in here. But by no means is oil, out of the woods. We made a slightly lower low on this pivot right here. And probably what we're going to have is some sort of rally, but then a failure, and then back down here to this support box. That's why I have it drawn here. So, I'd stay clear of any kind of oil investments. Exxon and Schlumberger and Chevron Phillips and all these companies. They're safe. They're kind of safe investments, but they're only as safe as relative to where oil is going to be. So if oil is going to be a lot lower, then they're not very safe at all. So probably what we want to do is start to look for some sort of divergence between the XLE or one of these ETFs and oil. And once we see some sort of divergence where the stock is moving up and oil is still moving down, that's probably where you want to start looking at taking some positions in oil stocks. All right, let's see. Let's look at the British pound US dollar. Let's go back to currencies again, because I was speaking about this potentially being a very large ABC, and then we get a good strong rally. That theme has continued, but as I mentioned, it's kind of weird that the equity market looks so soft when the currency market looks really strong. So maybe that's why it looks soft, is because since the currency is gaining strength, presumably exports will be more expensive for Great Britain, and with this whole Brexit thing, maybe the equity market's telegraphing that that's not a good thing. But again, if you're just an investor, you don't have to invest in the FTSE. You can go, we've talked about this before, you can go invest in the FXB. The FXB is still moving up slowly. Let's let it come up here. Okay, there's the FXB. You can see that we're making higher highs and higher lows, expecting it to move up into this resistance area before we get some sort of pullback. So if you want to invest in Great Britain, maybe stay away from equities, but invest in the currency. I know that sounds weird, but it is what it is. All right, let's go back to the toss charts and look at gold and silver. Gold and silver are still a little bit off from one another, but they tend to come back together at some point. So you can see I was expecting gold to come down a little lower. It really hasn't done that. And I suspect one of the reasons it hasn't done that is because silver is kind of leading the market here. And silver made a lower low here. So silver's pullback, to me, looks complete. Now, for us to say for sure, or there's never any for sure, but for us to take a fairly low risk run at silver, you would want to see silver next week close above this high right here, and then you could go from there. All right. So what we want to see this market do, the silver market, is next week we want to see it close above this high right here. And if it does, that means our risk is from here to here, but our reward is up here somewhere. I mean, we got a lot of upside and not much downside. Those are the kinds of investments you want to make. And you can go back. We'll go back to gold real quick. Gold, you can see it did not make a lower low. So here's the equivalent low, and actually I don't know if it's that one or this one, but let's just say it's this one. You can see that it didn't make a lower low. So there's some divergence there between gold and silver, and I suspect gold is not going to go down any further. Again, if we get a close next week above here, then that's a pretty good indication that gold is not going to go any lower. And the only reason I say that it's probably not going to go any lower is because silver, has already made a lower low, and now you've got this, kind of an ABC kind of looking intermediate thing going on here. So I would look for silver. Now, if you're going to invest in one or the other, to me, the silver is a better investment, and I would look for it to move up to a pivot, off of this high right here. So basically, we can make a box right here. Would look silver to go to $19. Now, when it gets to $19, it's going to have some sort of pullback. The question is, does it pull back and make another low, or does it pull back? We don't know. We'll just have to keep an eye on it. It could just pull back to here and then continue higher. So we'll just have to wait and see. But certainly silver, if you're looking to take a position, silver is probably better than gold just because it's got further to run. The distance between here and here is greater than on gold. This distance to the swing into the high is only from here to here. So, gold, you're looking for a move from say 1232 up to about 1303. And I don't know what the percentage of that is, but I can just look at it and tell that that's not as far percentage-wise as the silver move. From here up to this high. So anyway, hopefully you're following along with what I'm talking about there, that I'm not confusing you. The other thing I wanted to do real quick, and I forgot to pull it up. Well, I'm not going to pull it up. We'll just do it next week. Nothing's going to change drastically between now and then. This is a weekly chart on the Dow Industrials, and you can see here we've got a 1, 2, 3, 4, 5. So probably this whole move here is wave 3, is my guess. From here all the way to here is a wave 3. So that means we're going to have some sort of wave 4, pull back into here, usually off of this pivot, because this was the pivot into the most recent low. Can you see that? See how this is the most recent low where the market changed? That's where you expect the market to typically pull back to. There's nothing magic about it being a wave 4. It's just that was the last pivot low into the high. So that's where we expect the market to pull back to. And of course that will be a 4 of just larger degree. And then you get a 5 into the top. So my point in showing you some of these pictures, same thing with the, you can see here with the ES, which is the S&P 500, you got a 1, 2, 3, 4, 5. And this whole thing is likely 3. So we're expecting some sort of pullback into this. Hold on, I'm on a monthly on this one. Sorry, let me put it on a weekly. That's confusing. But same thing on a monthly, right? You're looking at the same kind of deal. But here's what I was talking about. This is 1, 2, 3, 4, 5. This starting from here, this whole thing's probably 3. So let's look at that real quick. Whoops. Oh boy, I did something wrong. Yeah, I don't know. I've locked up. There we go. Locked up my charts there temporarily. Sorry about that. So from here all the way to here, wherever this stops, that's a 3, and then this would be 4. Probably not that deep, probably, because here's the pivot low, the recent pivot low. So, something just below that, and then of course the final 5 into the high. So again, we're getting very, very close to, some obvious looking charts. At least they're obvious to me. And I would just be cautious. I would not be doing anything, brand new in your portfolios unless you wanted to go ahead and take them to some level of cash or something. But that is it. I've got there's some really interesting stuff that Elliott Wave is doing that I'm going to try to share next week. It has to do with the market in terms of real money. So as everybody knows, we have a fiat money system. That means it's backed by nothing. It's only, the only reason it works is because I trust, you give me money you give me $1 for something that I give you in services, and we trust the money, okay? But the money itself is not backed by anything. So it distorts the real value of things. And Elliott Wave has done some really cool research where they've gone back and looked at the Dow in terms of the PPI, the Producer Price Index, and also divided by gold, which we've talked about in here before. And it's really interesting. They also divided it by what's called the SCB, which was like standard currency something. I forgot what it stands for, but basically they took the US dollar, the European euro, the Chinese, Asian currencies, and they kind of did an index of these currencies, just a basket, and then they divide the Dow performance by the currency. And that is really shocking because it basically shows that we've been in a downtrend since the 1929 high. And again, let me repeat that, 1929 high. So in terms of real money, or you could think of it in terms of standard of living, our standard of living has been thwarted, not reduced. I mean, we obviously have a higher standard of living today than we did in 1929, but it's been thwarted. It could be so much more if we had real money in our economy and not this phony money that some people benefit from and others don't. So that's the real problem with the money system. Is it's a tool of the political environment, and those that are more politically connected get the money first, and it's easier for them to get the money and so on and so forth. So anyway, I'm going to show you a couple charts. I think you'll find it interesting. Make sure you tune in for that. And I guess that's it for this week. Thank you for checking out the Middle Class Investor. Don't forget to share with your friends and family. I'm telling you, if you don't, you're going to be sorry you didn't. I promise you. There's going to be a lot of upset and gnashing of teeth when these markets, when the Fed hits the shan, so to speak. All right, everybody. We'll see you next week. Take care. Bye-bye.